Good evening, everyone. I am CA from Jodhpur, Rajasthan, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by CECLEA Committee of ICAI. It is my pleasure to be a moderator for this session on webinar on Complete Guide to FEMA. In a short while, we will start with the session. I would like to appraise you about the CECLEA committee. The committee, in line with one of the institute's objective partner in nation building and with a vision to contribute to economic development of India, aims to undertake such activities to technically equip, broaden the scope of expertise of the members to enable them to derive advantage in the rapidly changing scenario and to enable the members to render various business advisory and support services. The program for this evening is understanding about NRI opportunities and obligations under FEMA from one of our eminent speaker, CA Viren Doshi sir. Viren Doshi sir, he is a chartered accountant in practice since 2018 based in Gujarat. His focus area are inbound and outbound structuring for establishment in IFSC, structuring advisory for returning NRIs and migrating Indians, global exchange control regulations and advisory, compliance and representation services under income tax. He regularly contributes articles in professional journals. He has also addressed webinars hosted by other chapters or branches of ICI and other professional forums. Now, I would hereby request Mr. Viren Doshi sir to put some light on the topic of the day.
Thank you, Guldeep bhai, for such kind words. Good afternoon, everyone. I would like to present my topic today for the day and share my knowledge. I think, can I share my screen?
Yes.
Am I properly audible?
Yes.
So my topic for the day is non-resident Indians, opportunities and obligations under FEMA, and acquisition of immovable properties in India. So now today we will discuss what are the additional or opportunities or better opportunities available to NRIs for investment in India and for doing businesses in India under FEMA regulations, as well as we'll also discuss acquisition of immovable properties in India. Now, before we jump over to the topic, background with respect to FEMA was already taken by C. Vishal Geda sir, and Rutik sir also exhaustively covered all the regulations related to capital and current account transaction. However, background on FEMA is very necessary in every session. So what I'll just give a few slides of introduction on FEMA, and then we'll start with the topic. First of all, why is FEMA important, or why is there a law of FEMA in India? There are two reasons. First is conservation of foreign exchange, and second is security reasons. Now, why does India need to conserve foreign exchange? Now, I may simply say as a layman that we can start giving away foreign exchanges, and what is the problem? The issue is India is an import dependent country. Our imports every month, our import bill every month is $60 billion. In case we have a decline or a steep decline in our forex reserves, then our inflation, our currency will get devaluated, it will get depreciated, and inflations and other economic consequences will follow. Plus, there are security reasons. India is a landlocked country. It is a peninsula. It is a landlocked country from three sides. Hence, it will try to protect itself from such that its strategic sectors and land are not being taken over by nationals who are a threat to our security. Hence, there is FEMA. To conserve foreign exchange, all these attraction events are applicable with respect to FEMA, which is dealing in foreign exchange or securities. If there is any dealing or if there are any of such transactions listed in this slide, FEMA will apply. So dealing in foreign exchange or foreign securities, transaction between resident and a non-resident, transaction in foreign exchange by a resident, transaction in INR by a non-resident, transaction outside India by a resident, and transaction in India by a non-resident. All in all, it will not apply to transaction between residents unless it is outside India or in foreign exchange. It will not apply to transactions between non-residents unless it is with respect to Indian assets or with respect to India, or the asset is located in India. So now, once we have discussed what will attract FEMA, what are the most sought answers under FEMA? Now, I try to keep this as simple as possible. Now, while we study FEMA, we see that the basic questions, the main questions which are being asked are whether something, when there is a question, we always think whether it is allowed or not. If it is allowed, whether approval is required. What are the terms and conditions applicable if it is allowed? If it is violated, what are the procedures to be followed? So the answers to it is, before we jump onto these conclusions, there is an approach which we have to see, and that is, first of all, there is a transaction. The transaction needs to be classified into capital and current. Now, current and capital transaction was taken in detail yesterday by Rutik sir. Now, once I determine whether a transaction is a capital account transaction, it is prohibited. Then I need to check, I need to pick up my books, I need to see section 6 of FEMA, I need to pick out relevant regulations and notifications and see whether it is allowed. So if it is not allowed in those specific regulations, it is prohibited. But now when we see for current account transactions, I would reply to myself when I determine that it is a current account transaction, that it is allowed. However, I need to open up section 5, I need to open up current account regulations and other relevant notifications and see whether it is prohibited. If yes, then it is not allowed. However, if there is nothing specified in these documents, then it is allowed. So this is the scheme of law, and the basics of the law with respect to FEMA. One needs to understand that FEMA is not a revenue law like income tax and GST. It is a policy law. As I discussed earlier, that India wants to conserve foreign exchange. India wants to protect its borders. It wants to keep its strategic sectors to itself. So in case there is a drafting issue in the law for which a person may claim that the investment is correct, say a person from Pakistan comes into India and buys land, and there is some technical issue in drafting of the law, still the law will be considered as per the policies of the government and not by the letter. Now this FEMA is regulated by central government and Reserve Bank of India. Earlier it was only regulated by RBI in consultation with central government. The act was later amended in 2015, and central government now regulates all non-debt instruments, and Reserve Bank now regulates all debt instruments, and it provides notifications accordingly. This law is administered by AD category banks, that is authorized dealer or authorized person banks. It is normal banks. FEMA again is not a complete law. We will see various transactions in this lecture itself, wherein I'll show that there are a lot of things which have not been specified in the law. However, those are practical transactions, and there should be a solution for it. Now, whenever we practice in income tax companies at GST, we always look at a transaction after it has happened. However, FEMA is such a law wherein you need to look at it before entering into a transaction, because the transaction may itself be prohibited. Criminal prosecution earlier under FEMA was not possible, or it was in very rare circumstances. However, situation has changed post amendments proposed by Finance Act 2015, wherein section 37A has also been introduced and section 13 has been amended, such that any violations outside India, if a resident violates any FEMA law and he has assets outside India, so for the amount of violation, equivalent amount of Indian assets can also be seized. Now, the way there are 3 golden rules of accounting, I have just tried to put up 5 golden rules of FEMA, which is that what cannot be done directly cannot be done indirectly. So if there is any structure, the way we try to do under revenue law, we try to pick the year other way around, we try to twist the transactions, we try to do a lot of things, but that is not possible under FEMA. If it is not possible directly, you cannot structure it in any manner under any law of the world, it cannot be done indirectly. all NRIs are non-residents. All non-resident Indians are non-residents, but all non-residents are not non-resident Indians. You'll come to know about this in the next slides, but this is very important because generally a layman considers any person who is not in India as an NRI. If there is even a foreign citizen who has no connection with India, we will call him an NRI, but he is an NR. He is not an NRI. We'll come to the definitions and you'll get much more ample clarity. FEMA residential status is different from income tax residential status. A person may be a non-resident under FEMA income tax, but he may be a resident under FEMA and vice versa. Capital account transactions are not allowed unless specifically permitted, and current account transactions are allowed unless specifically prohibited. Now, jumping to the topic, NRIs, obligations and opportunities under FEMA. Now, what all additional opportunities do non-residents have? And due to such opportunities, what additional compliances or what additional things do they have to follow is the matter of our discussion in the next few slides. We have only covered the additional opportunities which have. Now the opportunities which are already available for non-residents as well as non-resident Indians, those we have not covered in these slides. Residential status under FEMA. Who is a resident? A person is resident in FEMA if he has resided in India for a period of more than 182 days. But it does not include, so this is important. Now, if a person has even stayed for a period of say 200 days, however, if he goes out of India for the purposes of taking up of employment, for the purposes of carrying on business, or for any other purpose which indicates his intention to stay for an uncertain period of time. So the idea is that once you, and one needs to note here that in income tax, residential status is same for an entire year. However, under FEMA, it is not the case. Say a person has stayed in India for the period 1st April 2022 to 31st December 2022. Now that person is shifting from 1st January 2023 for employment to say UAE. So from 1st January 2023, that person is a non-resident of India. So the residential status in FEMA changes accordingly. Similarly, if a person has not stayed in India for a period of 182 days or more, but he has come to India and he stays in India for taking up employment, for carrying on business, or for any other purpose which would indicate his intention to stay in India for an uncertain period of time. Now, there is a what we say that you need to determine uncertain period of time. Uncertain period of time cannot be subjected to certain events. Now, say for example, there is a senior citizen couple which is staying in UAE. They have come back to India for certain treatment. Now, say the wife is ill, the spouse is ill. The husband says that I am in India for a period of time till my spouse recovers. Now, there is no certain period of time of recovery of that person. Hence, you cannot link your stay or your certainty to stay to happening of a certain event. That is what needs to be kept in mind while considering residential status under FEMA. And I would, for the sake of repetition, I would again say that you need to see to it that residential status under income tax is different from residential status under FEMA. For corporates, any person or body corporate which is incorporated in India is a resident in India. Any office, branch, agency in India owned or controlled by a person resident outside India. So any person, say there is a company in UAE which has an office in India, that branch is considered as a resident of India. As well, any branch outside India of a person resident in India is also a resident under India. Connection or there is a special privilege treatment being provided to people who have had connection with India, some or the other connection with India. So any person who is residing in India, who is residing outside India, if he has some sort of connection in India, they are classified into three categories. One is If the person has gone out of India, is residing outside India, but is a citizen of India, he'll be considered as a non-resident Indian. Okay. Any person who has gone out of India and accepted foreign citizenship citizen who is holding OCI card will be considered as an overseas citizen of India. Now, a person who is not an NRI, not an OCI, however, he is a foreign citizen other than the citizens of Bangladesh or Pakistan, who are persons of Indian origin up to 4th generation. That is, there is a person's child, grandchild, and great grandchild. So, if my fourth generation before, that is my dad, my grandfather, and his dad, if he had any connections with India or he was a citizen of India, then I'll still be considered as person of Indian origin. Plus, any person who has this link up to 4th generation with India, such person's spouse will also be considered as persons of Indian origin. Now, persons who do not have connection with India, they'll be treated as non-resident or person resident outside India. So you will be able to see that NRI is a person resident outside India, but a citizen of India. NR is a person who is residing outside India and a foreign citizen, who is not an OCI, who is not a PIO. So hence this difference is very important. It needs to be kept in mind every time FEMA is being studied. Now, we discussed this person of Indian origin. Now, there are a couple of points which I would like to highlight here. That concept of PIO was there earlier. It has been discontinued by the Ministry of Home Affairs since January 9, 2015. A notification was given that all the persons of Indian origin are deemed to be OCIs. All PIO cards were deemed to be OCI cards. Now, a case where PIO, there was a person of Indian origin who did not hold PIO card, and he has still not obtained OCI card, he'll only be able to, the privileged treatment to him is only restricted to opening of bank account in India and remittance of assets outside India. So although I have an Indian connection, I am a person of Indian origin. If I do not have an OCI card, the only privilege which I enjoy is opening of bank account in India, that is NRO, NRE, FCNR accounts, and remittance of assets outside India, both of which we'll discuss in detail in the coming slides. If I want to invest in India, although I have a connection with India, still since I do not have an OCI card, I can invest only at par with non-residents or persons outside India, person resident outside. Now, coming back to the main part, I'll just take 1 sec. I'm just interested. So, as I discussed that the topic is opportunities and obligations for NRIs. So any benefit or any privilege available to NRIs over NRs, we are covering that slides here. We have tried to bifurcate it into 6 categories. First is bank accounts and deposits, which will have contents of NRE accounts and FCNRB accounts. Repatriable deposits with Indian companies, which is only for the purposes of renewal. Non-repatriable deposits. Then is capital market. Capital market is listed non-debt instruments, listed debt instruments, listed unlisted debt instruments, exchange traded derivatives. Investment in business, deemed domestic investment and convertible notes of startups. Immovable properties, which would include acquisition of immovable properties in India, which is we'll try to cover this in the next part, in the second part of the presentation. Borrowing and lending, loans which NRI can beneficially get in India, and lending which it can do over non-residents. And other facilities would include remittance of asset scheme, gold bars, jewelry, etc. So what we have tried to do here is in our view or in our understanding, where NRIs can invest or NRIs foresee to invest or they want to invest in India, those issues we have, those places we have covered. We'll go one by one. there may be certain repetition because we'll have to cover all separate regulations, because bank accounts are separate regulations, capital market is separate regulations. In capital market, you have debt, non-debt, those are also separate regulations. So there may be certain amount of repetition. Investments in capital market, listed non-debt instruments. So as stated earlier, that earlier everything was to regulated by Reserve Bank of India. Now non-debt instruments rules have been given by Ministry of Finance, that is the government of India, and debt instruments are regulated by the Reserve Bank. Listed non-debt instruments, this facility to NRIs and OCIs is provided in Schedule 3 of NDI rules. Now, this facility is such that any non-resident Indian or overseas citizen of India, such person is freely allowed to purchase or sell on repatriable basis. Repatriable basis is once you invest in India, you can easily take out the sale proceeds outside India under automatic route. You do not need any approval either of the AD Bank or of the RBI. However, there may be certain documentation requirements, but under the law, it is fully repatriable, means you whatever you have invested plus whatever gain you have, you can fully repatriate it outside India. So NRIs or OCIs can invest in listed non-debt instruments on repatriable basis. Now, these instruments would include listed equity instruments on a recognized stock exchange, units of equity-oriented mutual funds, and purchase or sale of public sector enterprises shares which are being divested by the central government. Now, the conditions which you need to remember is, in case of all the transactions under FEMA, all the transactions need to be routed through single AD branch. You cannot keep separate banks for separate transactions. With respect to listed equity instruments, individual holding cap of a NRI or a OCI is 5%. Total cap of NRIs and OCIs investments on repatriable route in a particular share is 10%. If the relevant company wishes to increase it to 24%, it may pass a resolution with respect to the same and intimate it to the stock exchanges. This is the benefit provided to NRIs and OCIs. In case non-residents or foreign citizens who have no connection with India, if they want to invest like this, they have to become an FPI or an FII. Only then can they invest in this manner. This is an additional benefit provided to NRIs and OCIs. One more thing which I'd like to highlight here is, here the units of equity oriented mutual funds, the criteria is 50% or more investment should be in equity. When we go to the income tax, the criteria is 65% or more in equity. So you need to see while investing that what is the relevant criteria of the fund. So it may so happen, if it invests, generally equity oriented funds are investing more than 65%. It has become the habit of the fund managers, but in case it is so, then you need to check it. Debt instruments, listed non-debt instruments, debt instruments. The way NRIs or OCIs were freely allowed to acquire non-debt instruments on repatriable basis, similarly, debt instruments are also allowed on repatriable basis. This is provided in Schedule 1 of Debt Instrument Regulations 2019. These regulations have been provided by RBI. Now, what can be acquired in terms of debt instruments? First is government dated securities, treasury bills, units of domestic mutual funds or ETF, which of course invest less than 50% or equal to 50% in equity. More than 50% are covered in equity oriented. All non-convertible or redeemable preference shares or debentures, which are not part of equity instruments, are considered as debt instruments, and they can also be acquired under repatriable basis. Furthermore, listed non-convertible and redeemable preference shares or debentures can also be acquired on non-repatriation basis without any limits. Bonds of PSUs and infrastructure debt funds and any debt instruments. Now, this has not been an issue recently, but before a couple of years back, Indian banks were going through a lot of issues of capitalization. Minimum capitalization was not there. So they used to issue debt instruments. So any debt instruments issued by the bank which are eligible for inclusion in bank's capital, be it tier 1 capital, tier 2 capital, they can also be purchased by NRIs or OCIs on repatriable basis. Derivatives, all investment as well as trading in exchange traded derivatives by NRIs or OCIs is allowed. Furthermore, RBI has also permitted providing relevant collateral, whichever is required. Others is chit fund is not allowed under FDI route. However, if you are an NRI or OCI and you want to invest under repatriable route, you can subscribe into this debt instrument. You can also subscribe to National Pension System, given that you should be eligible to invest in PFRDA in accordance with PFRDA Act. Furthermore, annuity received or annual income received on such pension is a current income and it can be free. It can freely be repatriated outside India. Now we have taken one part. There were 6 chunks wherein we had divided. One was capital market. Now we come into business, investment in business by NRIs or OCIs. Now there is a special provision under FDI rules, under NDI rules, that any investment done by non-residents or non-resident Indians or overseas citizens of India in accordance with Schedule 4 of NDI rules, such investment will not be considered as foreign investment. It will not be considered. It will be considered to be. It will be deemed as domestic investment. No FDI policy will apply. No sectoral caps will apply. So NRIs or OCIs, they can do at par FDI with NRs. They can do under repatriable basis. Under non-repatriable basis also, they can do investment. That investment, it can not only be done individually. It can also be done through companies which are owned and controlled by NRIs or OCIs. It can also be done through trusts. It can also be done through firms which are incorporated outside India. Now, this concept was also there in previously. I think that was scrapped in 2002 or 2003. Overseas corporate bodies. It has now been sort of reintroduced in a much liberal way. And one needs to note that there is no definition of trust or firm provided, and there is no clear definition of ownership and control which has been provided. There is only one place wherein ownership and control has been defined in NDI rules, and that is Rule 23, that is downstream investment. So whether it can be used here or not is a question. However, you can take a holistic view wherein NRI has substantial interest and it takes part in management. So such companies may invest in India under non-repatriable basis. Where can it be invested? The way you were allowed, the way NRIs or OCIs were allowed in equity instruments of listed companies in repatriable route, similarly under non-repatriable route is also allowed. Units of equity mutual funds are also allowed under repatriable route. It is also allowed under non-repat. Additionally, in equity shares of unlisted company, capital of LLP, units of investment vehicle, and convertible notes. All these things, NRIs, OCIs, individually or through their companies owned and controlled by them, firms owned and controlled by them, or their trusts, they can invest in India without any limit on non-repatriable basis, such that whatever investment they've made, they cannot remit it freely outside India. Investment can be made from by debit to NRE account, by using funds from NRO account, or by receiving inward remittance through banking channels from outside India. Sale proceeds, as we discussed, this route is on non-repatriable basis and it has been deemed to be domestic investment. Sales proceeds cannot be transferred directly to NRE or bank account outside India. It has to be transferred to your non-resident ordinary account. Can investment in any types of companies be made, in any types of LLPs be made? No, there are certain restrictions. Such restrictions are include equity instruments of or units of Nidhi company. Such units cannot be acquired by NRI. Agricultural plantation activities or construction of farmhouses cannot be done by NRIs or the company in which they are investing. Real estate business is not allowed. However, township planning, real estate leasing, everything is allowed. Dealing in TDRs is not allowed. There is also no prohibition on retail trading. So these are the restrictions in for investment. Otherwise, it is fully allowed, and it is a very good scheme because the company which is receiving and the investor will not have to undergo any foreign FEMA compliances. There will be no FDI link conditions, and this investment will be considered at par with domestic investments. transfer. Transfer from non-resident or OCI to non-resident, NRI or OCI to NR, person who does not have any connection with India. So that person is not allowed to invest in deemed domestic investment route. He is only allowed to invest under FDI. Hence, relevant sectoral caps will apply, relevant pricing guidelines will apply, and all the other conditions will apply. See, because the idea is that Indian government and the RBI, they want to give benefit to NRIs and OCIs. Similar benefits are not available to non-residents. So when the equity stake or the capital stake is being transferred to someone who is not allowed under relevant route, then at that point of time, the benefits which were given, they need to be taken back. Relevant restrictions need to be applied. Relevant conditions need to be checked. Those conditions are sectoral caps. Sectoral caps is, say for example, sectors like civil aviation. Civil aviation sector, you can only accept 49% FDI under automatic route. Now, in case there is a person who is holding under, say, domestic route, he wants to transfer, and if that threshold is breached, then it is necessary at this point of time only that relevant restrictions are checked, pricing guidelines are checked. Pricing guidelines are checked such that there should not be a higher amount of equity share. For example, fair value of equity share is say 1 lakh rupees. But if it is being transferred at 60,000 rupees, then there is a loss of 40,000 rupees of foreign exchange to India. Indian FEMA would not need that, would prohibit that, and hence pricing guidelines are applicable. However, if a person is holding a security under non-repatriable route and is transferring to another OCI or NRI under non-repatriable route, these conditions are not applicable. A gift from NRI or OCI to non-resident. Any gift from NRI to a person who has no connection with India, prior RBL approval will be required. Even in case of such approval, such non-resident should be a relative as per the definition of Companies Act. Such person should be otherwise eligible to hold such instruments, and there are various other conditions in Rule 13.3 which need to be followed. However, if gift from NRI OCI is to another NRI OCI who is going to hold such funds on non-repatriable basis, then no conditions are required. Deemed domestic investment, partnership firm or proprietary concern. We already discussed deemed domestic investment in companies, LLPs, investment vehicles. Now we'll see for deemed domestic investment under non-repatriable route in partnership firms and proprietary concern. Here, proprietary concern means NRI doing business in India under its own proprietorship. It is not that he can give capital to some other proprietor. That will be sort of form sort of an AOP or in itself an overall partnership. So investment is allowed in capital of Indian partnership firm or proprietary concern. The restricted businesses are agricultural activities, plantation, construction of farmhouses, print media. Print media was not prohibited for companies. Real estate business is again prohibited here, but real estate leasing is of course allowed. Mode of payment will be the same. Sale proceeds can go to only to NR account since it is a non-repatriable investment. What are the other benefits of investment under this non-repatriable route? First of all, there is no lock-in period. Under various FDI routes, there are various lock-in periods of 3 years, 5 years, 2 years. There is no filing requirement. However, it is advisable that you write to your AD bank that I am a non-resident Indian, I have invested in so-and-so company, and it is under non-repatriable route. There is no valuation requirement. However, you need to check 56 to 10 of income tax. You need to check relevant provisions, otherwise you'll end up paying income tax. No limit for investments. Limits for NRIs or OCIs under repatriable route for portfolio investments will also not apply. That is, we already checked. See, I'll just take you back to the slide. See, there is this cap provided here that NRIs or OCIs investing in listed equity instruments on a stock exchange, there are these caps, individually 5%, total 10%, which can be raised to 24%. However, in case you are investing under non-repatriable route, it is deemed as domestic investment. Hence, these limits thresholds will also not apply. And since the only con or the only issue with this scheme is that the funds are non-repatriable. However, you can still use USD $1 million scheme. This scheme will also discuss in the coming slides. Now we'll just take a couple of case studies to bring certain clarity, and I need to also highlight certain issues. Mr. Jain, an NRI based in UAE, wants to do the following. First is, he wants to buy units of Kotak Focused Equity Fund, which is an equity mutual fund, to the tune of 50 lakhs out of funds held in his NRO account. He predicts substantial intraday movements in shares of RIL. He hence pledges his existing shareholding in Demat account and buys shares of RIL. Now, we need to guide him on FEMA regulations. Now, first of all, since these are equity mutual funds, investments can be made from in two manner. One is repatriable, second is non-repatriable. In case you are making repatriable investment, funds need to come from NRE account or from outside India. You cannot invest from your NRO account and make the investment repatriable. So since he wants to invest from his NRO account, no problem, that is allowed, but it is on non-repatriable basis. Secondly, there are similar regulations for debt mutual funds as well. Secondly, NRI or OCI cannot do intraday trading. They cannot do buy today, sell tomorrow transactions, that is BTST. Furthermore, they cannot even place as margin equity shares held by them in Demat account. Consideration needs to be paid in specified modes, that is NRE, NRO, or inward remittance. One thing which one needs to remember in capital account transaction is that you can only do things which have been provided in black and white. You cannot go out of that. If you have been told that mode of payment with respect to acquisition of equity shares in India, with respect to equity mutual funds in India, is from funds held in your balances, in your NRE account, in your NRO account, in your inward remittance, or through your inward remittance, you cannot pledge your equity shares as margin and can obtain funds. And such is a loan transaction, which is also not specifically allowed. Hence, this needs to be specifically kept in mind. A lot of NRIs are making these mistakes. So if you have any client, you get any such queries, you need to advise accordingly. I'll take another example, which is of investment through firms. Mr. Gandhi, a resident of India, and Mr. Shah is an NRI. They decide to invest in Indian stock market. They have decided to undertake only long-term investments. Now, how do they want to make investment? They want to float and register a partnership firm in India. Now, is this transaction valid? Now, investment in partnership firms by NRI is only covered under Schedule 4, as we discussed. It is not covered under repatriable route. So under Schedule 4, there is a list of activities which are prohibited. Investment in equity shares is not prohibited. So from FEMA angle, investment activity for non-repatriable investments is allowed. It is not specifically prohibited. Hence, he can do. However, a partnership firm which specifically which is engaged in the business or in the activity of investing in shares, NBFC regulations will apply. And a lot of people, we have got certain many cases wherein people float a private limited company, they create a private limited company, they infuse capital, and then they invest in shares in equity market. And then they have started getting notices from RBI and ROC as well that this is a financial sector activity and they need to register as NBFC. Investment in business. Now, we had already discussed, we discussed investment in capital market, then we came to investment in business. In investment in business, we discussed deemed domestic investment and in companies and in partnership firms proprietary concerns. Now, under normal FDI, these investments under Schedule 4, that is of non-repatriable basis, are treated as domestic investment and it's not FDI. For FDI, there are sector-specific benefits under Schedule 1 of NDI rules for NRIs or OCIs. Now, FDI in the sector of scheduled air transport services or domestic scheduled passenger airline or regional air transport service, FDI is allowed under automatic route without any restriction, subject to certain conditions, up to 49% for everyone, including foreign citizens, foreign companies, everyone. However, if you are an NRI, not even, here the term OCI is also not used, only for non-resident Indians, that is a person who is resident outside India but a citizen of India, you can invest under automatic route up to 100%. Similar condition was also imposed while disinvestment of Air India, which is foreign investments in Air India, including that of foreign airlines, should not exceed 49% directly or indirectly, except in cases where NRIs who are Indian nationals, where foreign investments is permitted up to 100% automatic route. So by seeing these clauses, there is one more. Construction development, townships, housing, built up infrastructure under 100% automatic route. There is one condition that any foreign citizen, foreign company, PRO, anyone can invest under 100% automatic route for construction development as specified. However, there is a lock-in of 3 years. A PROI shall be permitted to exit and repatriate foreign investment before the completion of project under automatic route, provided that a lock-in of 3 years calculated with reference to each tranche has been completed. However, this condition is not applicable to NRI or OCI investors. So both have been given benefit. So here you will get to know that you will get to see the idea or the policy of the government that they want to give a benefit to non-resident Indians who have a connection with India. Now we'll move to next, bank accounts and deposits. Normal foreign citizens or NRs or PROI who do not have connections with India, they are allowed to open NRO account. In addition to NRO, NRIs can as well open. NRIs and PIOs. PIOs are persons about the 4th generation, which we discussed earlier. So NRIs and PIOs are allowed to maintain NRE account as well as FCNRB account. They can also extend deposits. Now, this repatriable deposits, they were allowed earlier. Now they are only allowed to be renewed. They can still advance deposits on non-repatriable basis to company or former proprietorship. Under for NRE account, NRIs and PIOs are allowed. Such account is maintained in INR. It can be opened in form of savings account, current, recurring, FD, whatever there are. This is the list of permissible credits. Now there is one issue in this, that when can you transfer your funds from NRO account to NRE account? Earlier there was no clarity. However, this APDR circular was issued way back in 2012 that NRO to NRE accounts transfer is allowed. Permissible debits include your local disbursements, remittances outside India, transfer to any other NRE, FCNRB accounts, for making any repatriable or other investments. As discussed, if an NRI is holding this NRE account, he wants to invest in capital market, he wants to buy listed equities, he can do it using this NRE account and any other transaction which is allowed by RBI. Now, an additional benefit which NRE account has is that it gives loans in 3 manners. First is to the account holder, second is to third parties in India, and third is loans outside India to the account holder as well as third parties. Now, to account holder, loans can be given for personal and business purposes. In case it is for business, prohibited sectors are agriculture activities and real estates. Investing under non-repatriable route for investing in Indian companies or firms. Acquisition of immobile property in India, but it has to be for own residential use. Repayment is flexible. It can be done from NRO, NRE or fresh inward remittance. Such loans can also be extended to third parties resident in India by keeping their fixed deposits as collateral. It can be individuals, firms or companies which are resident in India. It can be for personal or business purposes. And again, prohibited sectors would apply, that is agriculture or real estate. In case NRE account holder wants to obtain loans outside India by giving such security as collateral, it would be authorized dealer branch may allow foreign branches outside India, their foreign branches outside India, to grant loans to account holder or third party as account holder may say. It should be for bona fide purpose. It should not be used for relanding, agricultural activities or real estate. And it should be against security of funds held in NRE accounts. Furthermore, in case of default, such amount which has been kept as collateral can also be remitted from India to outside India to the relevant foreign branch of the AD bank. Other regulations is NRE interest is exempt from income tax, and earlier the balances held in NRE accounts, be it savings, recurring, FD, current, all such balances were exempt from wealth tax as well. Wealth tax has been abolished, so it is just for your information purpose. And now this is one thing which one needs to remember is, now say there is a non-resident Indian who has a NRE account in India, and he has made some resident as his nominee. Now that person passes away. There are certain funds in NRE account. Now he also has certain liabilities for which payment needs to be made from India. Now say there is 15 lakh rupees of liability outside India, say in US. That person has funds of 20 lakh rupees in his NRE account. Still, that resident nominee has to go to RBI for approval of for payment of such liabilities. As illogical as it may sound, but this is the law. Specific issues. Gifts from NRO account to NRE account is not allowed. As stated earlier, that in this permissible credits and permissible debits of NRO, NRO to NRE account permission is only given for the purposes of remittance of asset scheme and not for any other purpose. Hence, gifts given from NRO to NRE are not valid, and from NRE to NRO are also not valid. So in case you have any non-residents who are doing this way, you need to keep a check on it. NRE accounts we have done. Now FCNRB accounts. FCNRB accounts can only be in the form of term deposits. They are maintained in foreign exchange, and currencies can be USD, GBP, yen, euro, any, which are permitted currencies by RBI. Permissible credits, tax treatment, everything is same as that of NRE accounts, and all the terms and conditions for loans and overdrafts as are provided in NRE accounts shall also apply to FCNRB accounts. I think slide has been doubled. There is a repetition. And again, interest from FCNRB accounts is exempt from income tax. Non-repatriable deposits, as we discussed, NRIs or OCIs, NRIs and PIOs in this case, can also extend non-repatriable deposits to a company in India, including registered NBFCs, a proprietorship concern, or even a firm. Investment can only be from NRO account. One needs to keep a note of it, that it cannot be from funds received from outside India, or even from NRE accounts. It should be purely sourced from NRO accounts. You cannot divert funds from outside India or NRE, because the idea is that such deposits are only they should not increase the liability of payments outside India, and hence in terms of foreign exchange. Earlier, for repatriable deposits, public deposit scheme was compulsory. Now it can also be done under private arrangement, acceptance of deposits. Interest rates are not specified. See, this is again an issue. Now, the RBI has not specified interest rates. Now, you may pay interest at the rate of 18%, which is a general market-driven rate of personal loans or unsecured loans. Now, for deposit, you pay interest of 18%. The general low rate of the bank is say 6.5-7%. So anyone can question that why have you paid a higher rate of interest? So hence, as we stated, that it is an incomplete law. However, in case you are entering into such transactions, you need to keep proper documentation and see to it that interest rates provided are in line, and you can prove that these transactions are genuine and in not any other colorable devices. Now we'll come to borrowing and lending. Should we go to queries first, or should we close this portion first? I think I still have 10-15 slides, and then we can go to immobile properties. Kuldeep bhai.
Yeah, we can take the queries, as 4-5 queries are there.
Acha, okay, fine.
Yeah. And this is first from Aniket Porter from Pune. Sir, you gave the example of Indian couple from UAE who came to India for medical treatment. What will be their residential status?
Yes, but see, the point is that the stay in India is not for a certain period of time. It is for an uncertain period of time. And once they breach that threshold, and once they have come with an intention to stay in India for an uncertain period of time, they'll be treated as resident.
Okay. Next is NRI are allowed to invest in India, invest in listed shares in India. Various limits have been given in slide like 5%, 10%, etc. In certain sectors, FDI is allowed. For example, 49% FDI is allowed in such case, how will the 5 to 10% limit works?
That I can see that question. I can take it up from here.
Yeah.
It is that this monitoring is continuously done by SEBI and RBI together, and there are several limits. Now, this 49% limit is for, see, this is with respect to taking a stake in a company. See, when you do a portfolio investment, see, portfolio investment is you do not have any control in the company. When you are talking about FDI, right, you are taking a substantial stake in ownership, control, as well as management of the company. These limits will not are to be tracked by SEBI and RBI together. And if you would remember case, there was a breach of FPI limit of HDFC Bank a couple of years back or 3 years back, wherein trading was stopped once it breached the relevant 74%, I think, was the limit was breached, and then trading was stopped for a couple of days, and those who bought the shares at last were requested to offload. So that is how it works.
Now, various fixed deposits are provided by NBFC like HDFC, Bajaj Finance, etc. How can NRI buy it? Can you elaborate on this?
It's fixed deposits are okay, they can be bought by NRI, but you need to see to it that it is on non-repatriable basis and it is not for a period of 3 years. The regulations which we have stated, they need to be complied with.
Next, from Mailadur Charian from Kochi, what does it mean 50% or more than 50% investment should be in equity in the case of equity oriented units?
So that is, say, there is a mutual fund which has 1,000 crore of capex. Now 50% in equity means they can, for the rest 40, say they invest 51% in equity shares. By equity they mean equity shares of companies listed on stock exchange. For the rest, they can invest in debt instruments like government treasury bills or debentures of companies. There are many listed debentures or certain preference shares which are listed. So any other listed security other than equity, they can invest up to 49%.
Next, again from Mailadur from Kochi, is there any restriction as initial capital contribution to the MOA of the company should not be in cash by resident and non-resident? Can subscription amount in the MOE be remitted from NRO account on non-repatriation basis by an NRI?
So if I understand the question correctly, she wants to ask that if there is a resident as well as non-resident Indian, by non-resident I suppose it is an NRI. They want to float a company, they want to incorporate a company, and NRO account needs to be used by NRI for repatriation, for funding of initial capital.
Company.
Yes, that is allowed. NRO account is allowed.
Aniket from Pune, agriculture business is not allowed for NRI or foreigners, but agriculture is not really defined.
Agriculture is sorry, Kuldeep, I'll take it over. No problem.
Yeah.
Agriculture is, see, there are various sectoral policies or sectoral rates provided in FDI policy. That is Schedule 1 to NDI rules. You can pick it up and you can check. I mean, so there, whatever agricultural activities which have been allowed under FDI have been specifically mentioned. So it is not that it is not defined. It has been provided specifically in FDI policy as well as this FDI sectoral caps.
Okay. Ankush Pava from New Delhi. What if an NRI participates in algo trading of derivatives by his funds lying in accounts maintained in Indian banks?
So exchange traded derivatives are allowed. So algorithm trading is something in the manner in which certain things are being traded. So algo trading is per se not a separate thing, but trading and investment in exchange traded derivatives is allowed. So they can surely do.
Oh. Now next is from Tanan Rangamani from Bangalore. And non-resident is looking to invest in township development up to 70% of the project cost. However, he is looking to invest through equity at 20% and balance 50% through NCD with a 3-year of maturity with a coupon rate. Will this be allowed under the automatic approval route? Also, the coupon rate payment can be made as current account transaction.
Right, Kanan. See, there are a lot of questions in this. First of all, township development is falling under the relevant category of FDI policy. If yes, it is allowed under 100% automatic route. So equity is allowed. However, investing through NCD is a part of ECB, that is external commercial borrowing, and you need to check those relevant regulations whether you will fall under that or not. Of course, coupon rate, once you take an ECB, coupon rate is regulated and you need to check whether it is falling in that particular limits. And you can remit coupon rate as an interest can be remitted, even if it is $100 million. It is a current account transaction, it can be remitted. But you cannot mix FDI with ECB.
Aniket Borkar from Pune. Tata Coffee is a company engaged in business of growing of tea or coffee or papercan. Foreigners invest in this company as it is in the business of agriculture.
Tea coffee plantations, to my understanding, have been specifically allowed. You need to just check the FDI policy. I think there it will come. That you need to check. And I think we have a specific session on FDI of Hardik Bhai. I think that is on 8th or 9th. So he'll also be able to answer them.
Now,
But you
Amit
can see
Kothari,
schedule 1 of NDI rules. Yeah, sorry.
Amit Kothari from Mumbai. How is the total capital of 10% calculated in case of investment by individuals in equity? It is combined capital of family members because per individual there is a cap of 5% already.
So it is a total. All the NRIs or OCIs holding in a company, in a listed company, their investment total, it can be 5%. So one person cannot exceed 5% in total. All the chunk cannot exceed 10%, be it 100 NRIs.
Now from Tom Joes from Thrissur, what about the agricultural land already held by a person and later he becomes NRI?
Yes, Tom, you can refer to section 6.5. Any person who has securities, assets, immobile properties in India while he was a resident, he can continue to hold the same while he has becomes a non-resident. However, he cannot carry on agricultural activities.
Now from CA Sanjeev Uja from Kolkata, amongst restrictions under FEMA, one of the slides mentioned real estate. Does this mean no real estate activities are allowed to be funded?
Now, under real estate, there are specific provisions wherein township development, certain engineering is allowed. I'll just share in some time. I have a list at the flag end of my presentation. I'll share. So that is already there. So it is not that no real estate activities, but it is only into specified, like trading in TDRs is not allowed. Buying and selling of real estate immobile properties is not allowed. Township development is allowed that way.
Oh. Now Muralidharan from Kozhikode, NRE is doing consultancy business in UAE, accepting consultancy fee from India in his resident bank account. What is the taxability? It is
Section
from
5 of Indian Income Tax Act, any accrual in India or any receipt in India, deemed or otherwise, is taxable in India. But then you need to check your DTAA, relevant DTAA is.
Amit Kothari from Mumbai. What is the major difference between NRO? Only NRO.
Probably is trying to ask for NRO and NRE. See,
NRO
NRO
and
account
NRE,
is
yes.
maintained in INR in India. NRE account is sort of an external account. You can, for example, if you want to remit funds from NRE to your bank account outside India, there is no filing per se which is required. But while you transfer your funds from NRO to outside India or from NRO to NRE, you need to file your 15CA. There are a lot of requirements. You need to give bank. You need to prove that bank that your taxes have been paid properly, etc., etc. So non-resident external account is like an external account which is held outside India but in INR, from which you can freely do transactions of outside India. There is no bar.
Now Shramishta from Kochi, except as gifts, can any amount be transferred from an NRE to NRO account and vice versa?
Only for permissible credits and debits.
Tom from Thrissur, can an NRI promoter give unsecured loan on non-repatriation basis to a private limited company promoted by him? That is, NRI promoter hold majority shares.
If See, this is again an issue of ECB, but I think directors are not specifically allowed under borrowing and lending regulations. So you'll have to again go to ECB regulations and you need to check whether you can accept your loans from foreign shareholders. If yes, then you need to see the relevant purposes and the timelines, minimum average maturity period, etc.
Next from Aniket from Pune. A person can stay in India for more than 182 days. Then he will become resident. Then can he buy farmhouse in
So
India?
once a person becomes resident of India, he buys a property in India. Where will FEMA come into picture? Yes, he can surely buy.
Okay, we have done with our questions. We
Shall
can
we
proceed.
resume? Borrowing and lending regulations. Now, we discussed investments by NRIs into capital markets, into business, all the beneficial investments, not the ones which are at par with NRs. Now, for all the borrowing and lending that it's to be done by NRIs, which is allowed, there are following restricted end uses, which is business of chit fund or nidhi company, investment in capital market, including margins and derivatives. This means that you cannot borrow or lend for doing these businesses. Third is agricultural activities, real estate, and trading in TDRs. Now, INR loans from banks. Any AD bank in India is allowed to grant loans in INR to NRIs or OCIs for the purpose, for his personal purpose, business, acquisition of house or property in India, for a vehicle, or any loan which AD bank gives under its policy. Here, AD bank is responsible to see to it that such funds are not used for investing or doing any activities which are restricted. Loans from financial institutions, any registered NBFC, housing finance, or any financial institution can advance vehicle or housing loans to NRIs or OCIs. Restricted end uses need to be checked. Loans in INRs from employers, and employer within its staff welfare scheme can advance loans to its NRI or OCI employee. Restricted end uses again need to be checked. Loans in INR from resident individual, that is, resident individual can grant loan to NRI. Resident individual can grant loan to OCI cardholder if he is a relative. See, this relative condition is not there in NRI, it is there in OCI. Such loan should be up to LRS limit combined. So, say a person has utilized $1 lakh already in doing certain overseas transaction under LRS, he can only advance loans to the limit of $1,50,000. Restricted end uses again need to be checked. Now, in the next four sub-paras or paragraphs or points, I have highlighted this phrase, subject to terms and conditions of RBI. I'll discuss this at the last of borrowing and lending, but it is very important. So I've just marked it right now. We'll discuss it at last. Loans in Forex to resident individuals, any relative outside India, including non-resident. See, here I'm covering not only NRI, this is non-resident. So for a resident individual, any person who is non-resident, who is a relative outside India, can advance loan up to $250,000, given that person has not exhausted his LRS limit. In case he has used his LRS limit, you need to calculate accordingly. Restricted end uses need to be checked. Loans in INR to resident individual. Any Indian resident other than company in India can borrow from NRI. Any Indian resident other than company in India can borrow from relative OCI. So OCI cardholder, if he wants to give it to any Indian resident, he should be a relative. Restricted end uses again that need to be checked. For returning Indians, so for NRIs who have returned to India, they are allowed to service loans taken overseas and non-residents or non-resident Indians. Now, the phrase subject to terms and conditions specified by RBI. See, I even told this earlier at the start, in between, and this needs to be remembered while encountering any FEMA queries. In capital account transactions, unless something is specifically allowed, it is prohibited. Under borrowing and regulations, erstwhile before regulations 3R were released, 3R were released in 2018. That is revised notifications. There were borrowing and lending regulations of 2000 updated from time to time. There were also certain conditions which were provided in the relevant notification. However, there was no APDIR circular. Now that notification has been replaced in 2018. More liberal provisions have been introduced in notification 3R. Also in notification 3R, while liberalizing, RBI has provided that there would be, it is the transaction of loan is subject to terms and conditions prescribed by RBI. Now it has almost been 4 years. RBI has not prescribed a single condition. The earlier conditions were under the old notification. There was no APDIR. So the earlier notification has been replaced by the new notification. So has the relevant amendments. There is no APDIR, so you cannot use those conditions as well. So as of now, I'll just go back to this slide. If there is an Indian resident, he wants to borrow from NRI, and NRI is allowed to give under regulation 6B6, right? However, since terms and conditions have not been provided by RBI, this transaction would go under approval route. It will not be under automatic route. One may very well say that since subject terms and conditions have not been provided by RBI, this is under automatic route. No. This is a very important point, and I like to highlight this issue. This issue was also highlighted yesterday by Rutvik sir, that with respect to returning Indian, that any person who has to service loans outside India, which he had taken when he was a non-resident, so FEMA was not even applicable. Now, since he has returned back, he has to service. Earlier in 2015 Master Circular on LRS, they had allowed. Now they are saying that since we have not provided any terms and conditions, it will not be allowed. Now, consider a case where there is a non-resident, he has to repay loans. He has to repay it within 60 days. Now, if I file an approval request with my bank, the bank is not even forwarding for 1 month. If I do not get my approval within 60 days, do I have any constitutional remedy or any other remedy available? So this is a very important thing. And while you advise your clients, you have to be very specific. And we have seen several lapses in the interpretation of this particular phrase, where people say that subject to terms and conditions specified by RBI. So there are no conditions. So there would be no conditions. So it is allowed under automatic route. But no, that is not the case. It is under approval route. Other facilities include remittance of assets outside India. So there is one thing where NRI has made or OCI has made repatriable investments. So say investment has been made of 1 lakh rupees, you earn 10,000 rupees on that, you are allowed to take 1,10,000 under repatriable route. However, when you invest under non-repat route, you have to keep those funds in India. So NRIs and PIOs are permitted to remit annually $1 million US. Repatriation is only allowed of non-repatriable investments because repatriable are already covered under the relevant notifications. Current income, repatriable investments are fully repatriable, so they should not be considered in this. You should also take care while computing annual limit for your clients, because we have seen a lot of cases where current incomes and repatriable investments are remitted under $1 million scheme, and people, when they want to actually use the scheme, there is no limit available, so they have to wait for a year or accordingly. And one thing with respect to current income, which also one needs to keep in mind, is that current income does not include capital gains. Current income with respect to capital gains income, sale proceeds are itself seen as a chunk or a whole unit. It is not divided into cost and gain like we do in income tax. Repatriation of $1 million US is out of balances held in your NRO account. It can be out of sale proceeds of assets. However, not more than 2 residential properties, sale proceeds of not more than 2 residential properties are allowed to be repatriated outside India. And this is now there is a small controversy whether it is an annual limit or a lifetime limit. In my view, it is a lifetime limit. Any inherited assets, any assets inherited are in non-repatriable nature. Such funds, sale proceeds of such assets can also be used under this scheme. Any legacy, any deed of settlement can be used. In case you are remitting in bits and pieces, then you need to keep a track of total remittances. Now we'll just like to take a few case studies. One is investment through LLPs. Now this case was also, I think, covered yesterday, and this has also been in news. and it is very important that how do NRIs twist the FEMA law. Mr. Ambani and NRI inherited various assets in India, which include shares, IPs, listed debentures amounting to $225 million. Now, if such person remits under $1 million scheme, it will take 25 years for him to remit. So he needs to go to approval route ideally. Now, what he does is he forms an LLP, transfers all the assets as capital, and then repatriates the entire amount as his share of profit. It is a current account transaction, no restrictions. See, NRI could not have done this directly. Prior RBI approval would have been required. And you need to remember 5 golden rules of FEMA. What cannot be done directly cannot be done indirectly. And such violations are not mere technical violations. If ED or authorities catch hold of you on this, they'll not spare you. And we have seen several compounding orders where people have made violations which are of serious nature and they are not technical violations. Then they have to actually pay 100% of whatever they have earned, or even more in certain cases. You need to remember that total penalty can exceed up to 300% of your transaction value. Leave apart gains or your income portion. So you need to be very thoughtful and very cautious when you plan such transactions. And other facilities also include acquisition of, say, there are a lot of NRIs who acquire gold jewelry, gold bars. People come for their daughters' weddings, they buy gold jewelry. Now, buying of gold jewelry creates asset in India of NRIs. That is a capital account transaction. There is no specific regulation. No specific regulation for such a simple transaction. So if I go with my normal interpretation is, it is a capital account transaction. It is prohibited unless permitted, not permitted, not allowed. However, as said, FEMA is not a complete law. General trend is acquisition of gold has never been questioned by RBI. People buy gold and keep in lockers. Hence, through general trend, we can deduce that it is allowed. I am reiterating that it has not been specified anywhere in the law. It is a capital account transaction. It is not specifically allowed. However, based on general trend and behavior of the RBI, we are considering it as allowed. Now, I think part A is over. We will shift to part B of my presentation. If there are any queries, I think we can take up.
Yeah, no queries till now as we have done with all. So we can proceed.
Okay. Yeah. Okay. So now we'll shift to immovable properties in India. Acquisition of immovable properties in India by NRIs, OCIs, and all other people. Layout. What I'll do is I'll give you a background first. Definitions: acquisitions by NRIs, OCIs, acquisitions by person resident outside India who do not have a connection with India, by long-time visa holders, by foreign embassies, diplomats, consulate generals, and all, and then miscellaneous provisions. As stated earlier, FEMA law was regulated by RBI. Now, central government has also entered. Section 6(2)(a) of has been inserted in FEMA. So earlier, the FEMA 21R acquisition and transfer of immovable property rules has been scrapped, and now the entire chapter of acquisition and transfer of immovable properties in India has been shifted to non-debt instrument rules. Reasons for regulating immovable property acquisition in India, as we discussed, that why is there FEMA? Then why is immovable property acquisition being regulated? The reasons are security reasons as stated, because we are a landlocked country. Any person can come in India who is, because of security reasons, we have to control it, and for pricing. So say what happens in equity market also, a lot of people or FIIs earlier, now we have a lot of domestic investors, but earlier we were so dependent on FIIs that if FIIs used to pull, our market used to crash like hell. So for pricing also, that cannot be done with immovable properties also. Now, general criteria under FEMA for deciding any sort of transaction, whether it is allowed or not, is residence. Whether you are a person resident in India, okay, it is allowed. You are not a person resident in India, it is not allowed. However, in immovable properties, residence is a criteria along with citizenship. So now these is in crosshairs. So now non-residents are not allowed, hence residents are allowed. So say if there is a person resident in India who is a citizen of Canada, he has come to India, he is staying in India, he has shifted to India, he is a resident, he has not accepted Indian citizenship. So is he a resident? No. So if non-residents are not allowed, residents are allowed? Yes. However, if he is a citizen of certain country, then he is prohibited. Now, who will track transactions of resident to resident in India for FEMA purposes? Hence, such transactions are very difficult to track, and FEMA is not applicable ideally for residents buying immovable property in India. So you need to keep a check that there are dual conditions, one is residence and one is citizenship for immovable properties. Provisions are liberal for NRIs and OCIs. There are very strict provisions for investment by citizens of certain countries, and immovable property regulations, which we are discussing, only covers investment in immovable property. Business with respect to immovable property in India is covered under foreign non-debt instrument rules, that is FDI policy. As we discussed, Schedule 1 and Schedule 4, repatriable, non-repatriable, everything, which will be taken in detail by Hardik Bhai. Any business related to immovable properties or acquisition of immovable properties for the purpose of businesses will be covered under India rules. So it is very important to distinguish. There is no specific threshold or there is no specific rule given to decide whether it is business or not, but it is based on facts. What are the available routes for acquisition of IP in India? One is NRIs or OCIs. NRIs or OCIs can also jointly acquire with their non-resident spouse who does not have a connection with India. Any non-resident having place of business in India can buy. Any long-term visa holders and foreign embassies, consular diplomat generals can also buy. Now, non-resident Indian, an individual resident outside India who is a citizen of India. OCI is who is a person who is registered as an overseas citizen of India cardholder. Relative everywhere in the FEMA law is now in sync with Companies Act, Section 2, Subsection 7. Now, before we go into what is allowed, I'd like to discuss what is prohibited specifically, very strictly. Any citizens of following countries are not allowed to acquire immovable property without prior approval of RBI. That includes Pakistan, Bangladesh, Sri Lanka, China, Afghanistan, Iran, Nepal, Bhutan, Hong Kong, Macau, and North Korea. 11 nations, no citizens in whatsoever manner through any entity, howsoever, and for this purpose, citizens would also include entities. No person, citizens, entities would not of these countries will not be allowed. However, if any OCI holder is resident in these countries, will be allowed to acquire. Citizens of these countries who are not allowed to acquire IP can take IP on lease in India, but for a period not exceeding 5 years. Citizens includes both natural and legal entities. Restrictions are based on citizenship, are strictly not as per FEMA because it is a security issue and hence needs to be followed. Violation can be compounded. However, we have seen that as much gain you have made in violation to these provisions are charged as compounding fees. What are do's and don'ts for NRIs? This is a summary which will discuss each point in detail. So NRIs or OCIs can acquire immovable property in India. They can sell such property. They can repatriate the proceeds back to outside India in majority of the cases. They can let out such property, earn rent and repatriate such rental income also, as it is current income freely repatriable. And they can bequeath the property to anyone. So they can will such property to anyone, even a person resident outside India, and on their death, such property can be transferred to such PROI. What NRIs cannot do is they cannot buy agricultural land, plantation property, and or farmhouses. So I'll refer to as agricultural properties because it's a very strategic sector. Enter in real estate trading is not not allowed. Trading of TDRs not allowed. So this is a chart of acquisition of property in India by NRIs, OCIs. So NRI, OCI, if they want to purchase what type of property, any immovable property other than agricultural properties, they can buy from any person. Now there is inconsistency in FAQ 1, which I'll discuss which I can discuss right now, that resident in FAQ1 they have stated that NRI or OCI can acquire only from another Indian resident, NRI or OCI. However, as per regulations and master directions, they can acquire from any person. They can also acquire from person resident outside India. However, it needs to be noted that person resident outside India who wants to sell the property, he has to take a prior RBI approval. See, the person resident outside India who wants to sell the property has to take RBI approval. However, if the buyer is an NRI or OCI, he does not need to take any specific approval for purchase of any immovable property other than agriculture. You can acquire by gift from an Indian resident. Now, acquisition of gift is also limited from NRI OCI to another NRI OCI if they are relatives. Under inheritance, you can acquire any IP. If it is from PRI, any IP. If it is from PROI, he should have acquired it in accordance with relevant FEMA provisions at that point of time. Transfer by way of sale or gift. Any immovable property can be transferred or gifted to Indian resident. Any property other than agriculture can be sold or gifted to NRI or OCI who is relative. It can be sold to NRI or OCI, any NRI or OCI. So what is allowed? Based on that, as a corollary to that, we can find out what is not allowed. So NRIs or OCIs cannot buy or cannot accept as gift any agricultural property. Such an agricultural property can be only sold or gifted if an NRI or OCI has to a person resident in India. However, they can bequeath it to anyone, including PRY. No property can be transferred by way of sale or gift to person resident outside India or non-relative NRIs or OCIs. See, they want to keep it very restrictive, the immovable property rules. So what they've done is, if you are gifting or transferring, it is only to your relative NRIs or OCIs. However, there is inconsistency in NDI rules and master direction, wherein the inheritance part has been stated that you can inherit only from PRY. However, it is actually from PRI and PRY as well. Payment from acquisition in IP in India can be made only out of inward remittances, NRE balances, FCNRB, NRO balances. Travelers check, foreign currency notes not allowed. No approval is required from RBI. No declarations required. Loans can be accepted by NRIs or OCIs for acquisition of IP in India in accordance with Regulation 7AI of FEMA 3R, as we already discussed in borrowing and lending regulations, that AD banks in India can advance loans for acquisition of property in India. Loans from employers also allowed. However, it is redundant because of terms and conditions have not been prescribed. Repatriation on sale will be freely allowed without approvals. So if an NRI or OCI has acquired property by way of debit to NRE account, by way of debit to or transferring funds from outside India, then it is a repatriable investment. So any immovable property other than agricultural property, if it is acquired in accordance with extant FEMA provisions and payment is made from NRE, FCNRB or foreign exchange received through banking channels, it is freely allowed to be repatriated. However, for residential properties, only sale proceeds of 2 residential properties are allowed, not more, even though they are under repatriable route. Only 2 residential properties. Benefit of $1 million scheme is available for non-repatriable investments. So if you have inherited or you have paid through NRO accounts, then only through you can remit it through $1 million scheme. Non-resident spouse who is not NRI or OCI. So if say there is a foreign citizen spouse of an NRI who has gone outside India, such spouse can also acquire one immovable property in India other than agriculture property. It should be jointly with their NRI or OCI spouse. Their marriage should have been subsisted for not less than 2 years. Spouse should otherwise not be prohibited from acquisition. Like say for a person of India goes to China, right? He has an OCI, can acquire property in India. However, he cannot jointly acquire it with his spouse because she is any which way is prohibited from acquire property as she is a citizen of China. Payment may be made from non-resident account held in accordance with FEMA regulations or by way of inward remittance. Okay. Now, person resident outside India, having branch office, project office, or any other place of business in India, such person can acquire property in India for permitted or incidental activities. Entities of 11 countries, as stated in the first slide, of specific prohibitions they cannot acquire. Once they acquire a form in declaration IPI, declaration in form IPI needs to be filed within 90 days from the date of acquisition. A person resident outside India can mortgage such immovable property to an ED as a security or borrowing. So if there is a person resident outside India, so there is a firm, say in UAE, which has its branch office in India, it can acquire property in India. It can also give it as a security for borrowing, and it can be used only for carrying on permitted or incidental activities of the branch office. In case of sale, prior RBI approval is required. Long-term visa holders, being citizens of Afghanistan, Bangladesh, Pakistan, may purchase immovable property if they belong to specified minorities. So people who are minorities of Afghanistan, Bangladesh, Pakistan, who have come back to India because here their community is in majority and they have come because of security issues there also. If they belong to specified minority communities like Hindus, Sikhs, Jains, Buddhists, Parsis, and Christians, and if they were citizens of Afghanistan, Bangladesh, Pakistan, and they are holding long-term visa, they can acquire one residential immovable property as dwelling for self-occupation and only one immovable property for self-employment. And there are slew of other conditions which need to be met, of course, for security reasons. Foreign embassy, diplomat, or consulate general may purchase or sell any immovable property in India other than agricultural purposes. They need to obtain clearance from Ministry of External Affairs, and consideration should be paid out from funds remitted from abroad through banking channels. Foreigners. So any person who is not a resident, who is not an NRI or OCI, and he is a foreign citizen. So FDI route is open for foreigners to invest in an entity in India. Immovable property required commensurate to such business purpose can be acquired. So if you are starting a business in India, you need to buy an immovable property like an office or a godown or a manufacturer or a factory land. You can buy. However, care must be taken that land purchase is utilized for the purposes of business only. You have seen several transactions wherein people start trading in land. They have brokers who buy and sell lands before they start activities. That is not particularly allowed. Immovable property in India, creation of charge. Indian residents, see, this is a very unique and beneficial provision. That is, any Indian resident can create charge on immovable property in India in favor of overseas lender for obtaining ECB in India. So, say there is a person in India who is having its IP. Now, it can create a charge in favor of overseas lender, that is allowed, and on the basis of such property which is held as security, overseas lender provides funds through inner ECB route to the Indian entity. And in case of invocation of charge, the foreign lender can sell such IP only to an Indian resident. It cannot be sold to NRI, OCI, or any other foreign citizen, and sale proceeds need to be repatriated and liquidated. Loan abroad, NRI or OCI can mortgage their immovable property in India for taking loan from a foreign lender of a foreign company of which he is a director. Mortgage should be with a bank in India, which is Indian correspondent of an overseas lender. So any foreign bank which has its branch or a correspondent in India, with such Indian correspondent, NRI or OCI can mortgage his property in India for loan which needs to be taken from a foreign loan by a foreign company. So, say Coca-Cola Inc. US, they have an executive in India who is an NRI and he has IP in India. Say it is worth 100 crore rupees. They can give it as security to Indian correspondent of the US bank. Such US bank can on that basis create charge and advance loans to Coca-Cola Inc. in US. Funds should be used by the borrowing company only for its core business purposes. In case of invocation, Indian bank can sell the IP to an eligible acquirer and remit the sale proceeds. Now, as I stated, that immovable property in India regulations are very sensitive, and its consequences are not merely treated as technical violations. They are taken very seriously. Where you can of course apply for compounding. However, it needs to be regularized first. RBI gives around 6 months of time, and regularization of, say, a foreign citizen who is not allowed to buy IP in India, he buys IP. He is generally required to sell such IP to an Indian resident. You cannot transfer it to anyone else. Even to an NRI or OCI, although it is allowed, once you go for compounding, RBI, in our experience, generally tells that you have to transfer it to an Indian resident and citizen. Most cases of such violations are compounded by levying a very heavy compounding fee, and where source is not clear or is not through banking channels, such cases are referred to enforcement directorate. Compounding fee levied is as per matrix, and undue gain can be added because compounding matrix provides for that thing, and tax deducted as source has been reduced from undue gains in some cases. Compounding orders used to be placed on RBI website, resulting in name and shame. In case compounding fees are not paid within the specified time period, matter is always forwarded to enforcement for adjudication. Now we have a couple of interesting case studies here. Now in Indian real estate, since transactions cannot be done in a particular way, people try to twist the form of transaction. Now we will be dealing with such one such case that Mr. Piramal, an NRI, wants to advance loans of 10 crores to his developer friend in Ahmedabad, say Mr. Adani. Now loans to be advanced are for an ongoing commercial project, which is not eligible under FDI, I would say. Now FEMA borrowing and lending regulations are not allowed if they don't want to invest even in capital. So what does Mr. Piramal do is he books 15 offices worth 2 crores each. On booking, he advances such 10 crore rupees to Mr. Adani. Now, Mr. Piramal even receives booking letter. All the RERA formalities are completed. All the other legal formalities are completed. Now, after a couple of years, the builder, that is Mr. Adani, he cancels the deal and repays the sum with an interest of 12%. So, what has happened is the loan which they wanted to give under borrowing and lending regulations, which is not allowed, for which they required prior approval, what they have done is they have booked flats with the developer. They have kept funds, and the developer cancels the deal such that he has to pay interest of 12%, showing that he has violated. Now everyone is benefited, no FEMA in picture, and everyone is happy. But these transactions, although if you see independently that if someone has acquired an office, paid an advance, if the deal is cancelled, he is entitled to interest. However, if RBI catch holds of this, if ED catch holds of this, then that person will be taken out front, right, left, and center, because these are very serious violations. They don't want you to do a certain thing. They don't want you to do a certain thing. Okay, if you twist and do that, then you will be in a lot of trouble. Similar case study of agricultural property. Now, what we have seen, even in a country, developing country like India, which is having almost 60% to 70% agricultural land, the townships or real estate development happen by converting agricultural lands into non-agricultural lands, and then construction is taking place. So there is an NRI, Mr. Sheikh. He's a visionary developer. He wants to buy a piece of agricultural land in India, convert to non-agricultural land, and build township. Now, he is not allowed to buy agricultural land, we already saw. So what does he do is he incorporates a closely held company in India, say in 2021, and buys such land. Now, Indian company can do township development activities. That is allowed under 100% automatic. Now, non-agriculture application from conversion of agriculture to any application has been made. However, it would take almost a couple of years to process. That is what they anticipate. So what do they do is, Mr. Sheikh, that why to waste 1 year of land activities? Why to waste 1 year? So the company undertakes basic agricultural activities. It takes say 1 crop, 2 crop a year. Land was then converted in late 2022, and township development has now started. Now, is this arrangement valid under FEMA? Now, the first answer which would click in mind is that it is something which is done directly, cannot be done indirectly. Very right. However, secondly, on second thought, a lot of views have been taken in these lines also, that if I want to do a certain activity, it is not allowed under FEMA, but it is allowed in some other way. and the activity which I am going to do or which I've already done is bona fide, then RBI may spare you. That is what certain a school of thought is. Now, one may always take a view that what can be done cannot be done directly, cannot be done indirectly, and it is very true. However, if in a country like India, where you have 60% to 70% agricultural land, if you want to do township development, it is not possible to buy a land in a city area. You have to buy an agricultural land, you have to convert and then start township development. So, on one hand, you can claim that you have done it with a bona fide intent of doing township development activities in India, which is otherwise allowed under purely under FDI repatriable route as well as non-repatriable. However, what Mr. Sheikh did a mistake was his company undertook agricultural activities. See, agricultural activities is very sensitive subject and it is not allowed at all except it is specified under Schedule 1 of India rules. Now, since he undertook agricultural activity, even though his entire intention was bona fide, this transaction is in complete violation of FEMA regulations. So, in case you would not have conducted agricultural activities, he could have claimed that it was a bona fide transaction and this is the only way he could have done business in India, and he may have been spared. Now, my second part almost comes to an end, and I am going to discuss the issues or the mistakes which NRI does. So, should we take up queries or should we close a couple of slides and then take up queries?
There are 2-3 queries only, though I think we can take it in last.
Sure, we want to take it at last. Okay, fine.
Yeah.
So, we have just tried to make a couple of slides for mistakes or what we put it as gaps done by NRIs, the honest mistake, blunders, whatever they do. Now, and we have had various chartered accountants also who have, gone to UAE and they have not complied with FEMA regulations and now they are in trouble. What first thing they do not do is they do not convert their savings account, current account into NRO, NRE accounts. They hold it for a period of 2 years, 5 years, 10 years. So what happens is, once you go for compounding, every transaction you do, debit plus credit, debit plus credit, debit plus credit, everything you'll have to make a total, and that amount compounding fee will be levied on that amount. That is the seriousness of the violation. Similarly, what do they do is, the way we do UPI transactions in India between residents, they also do as non-residents. They advance loans to friends, they advance loans to cousins, everyone, and then they are in soup. Similarly, we have seen cases wherein NRIs or OCIs, they want to invest under non-repatriable route. That is Schedule 4, which is deemed domestic investment. However, based on certain misconceptions, based on certain wrong advices, they file FCGPR forms and they fall under Schedule 1 of FDI investments. So all the benefits of non-repatriable investments of deemed domestic investments are lost. Although the investment becomes repatriable, you have to follow FDI linked performance conditions, you have to do annual compliances. So although these mistakes are unintentional, it needs to be kept in mind while advising and while even structuring transactions, that there is that if you want to invest under non-repatriable route, there are no compliances except writing to AD banks. And there are such mistakes which we have seen that NRIs do. A lot of NRIs have not even converted their share trading account, they're kept as residents. They do not convert it into portfolio investment schemes, and they end up doing intraday trading, which is not allowed. BTSTS, buy today, sell tomorrow, it is also not allowed. Also, investments in India are undoubtedly lucrative. However, when a non-resident invests, he has to also check what is the exchange rate risk. Because if they do not factor in that, they'll only realize after a period of time, once they stop investing and they liquidate their assets, that, oh my god, I estimated an annualized return of 12%, 15%, but if my currency, Indian national rupee, is depreciating by 2% every year, or that 12% will come down to 10%. Now, once a person goes outside India, he takes up citizenship of some other country. He thinks that I am permanently non-resident of India. So he may have come to India for 200 days. They may not keep a check. They'll end up becoming residents of India, but they'll always be under an impression कि चलो यार मैं तो foreign citizen हूँ, I am a non-resident of India, and they always mix up citizenship with residential status, and they do not keep a track of their days of visit in India, and they end up in income tax troubles also. As I already stated, that capital account transactions are only allowed through specified modes. However, we have seen that people do equity investments in from India, from outside India, through payment gateways. They transfer whatever subscription capital is there through Razorpay, or there are various fintech applications. They use payment gateways, which is not allowed. You have to transfer for your capital account transactions using NRE, NRO, or FCNRB, or through remittances from outside India. Payment gateways are not allowed. Non-disclosure of foreign assets. So when there are returning NRIs, they even do not disclose their foreign assets after returning to India. So the consequences of BML are very harsh. Every non-reporting of asset, for each asset there is a flat penalty of 5 lakh rupees. So these are the mistakes which NRIs do, and you need to advise your clients accordingly, who are NRIs, that you need to keep care of these things. And it is not that you have gone out of India, FEMA does not apply. It is very much applicable to you, and you need to be very cautious by doing certain transactions. I think I am done with my slides. We can take up queries.
Okay. So now this is from Aniket from Pune. A PIO that is does not have Indian citizenship, does not have OCI card, but their parents are Indian. Can he buy flat or house in India? Was it allowed earlier and now it has been stopped because in older notification it contained PIO also?
Yes, Aniket, as stated in that third or fourth slide after various terms, PIO concept has been scrapped from January 9, 2015. All persons of Indian origin have been deemed to be OCIs. All persons who held PIO cards are treated as OCI card holders. Now, those PIOs who do not have OCI cards can have only two benefits of being PIOs. One is they can open bank accounts in India. Second, they can remit their assets from India. They cannot, if they want to access or invest anything, they have to do it as if they are non-residents.
Next is from Aniket from Pune. A Japanese man comes to India for starting a business. Therefore, his status under FEMA is now resident. Can he buy flat in India to stay here, or he can only take on rent?
So, a very good question. Again, this brings up that, a person who is a resident, and if he is buying property in India, but is a foreign citizen, then we need to check that list of 11 countries. I don't think so Japan is in that list. Hence, if you need to check that list again, but mostly Japan is not in that list. So if his Japan is not in that list, then he can, of course, he's a resident, he can buy a property in India, no problem. If he is in if Japan is in that list, says he is from China, so he can only acquire that property on lease for 5 years.
Again from Aniket, that in query case number 5 of Sheikh NRI, let's say Sheikh NRI comes to India, stays for 182 days in India, buy already any converted land, and then start township. Is it valid?
Why to come to India for 182 days? You can irrespectively buy non-agricultural land and do township development activities.
Okay.
So you'll have to advise your client accordingly. See, if someone wants to do township development in India and you want to convert that agriculture into non-agricultural land, you need to advise him accordingly that you can make an arrangement with the seller that you converted it for us and we'll buy, because an NRI is allowed to buy non-agricultural properties in India, and they are allowed to do township development activities also.
Okay. So we have done with all the queries we have. So any other queries are there? So I think we have done with all. And again, a great session today also in line. So on behalf of everyone present in the session, I want to thank you, sir, for sharing your expert view on this topic. We really appreciate the time you gave us from your busy schedule. hoping to hear you from again on this topic and other topic you have expertise in. So have a nice day, sir. Thank you very much for this great session.
I hope I have been able to add to your knowledge of whatever participants had. And I would like to also thank especially C. Rutvik Sanghi, who was kind enough to, share his presentation with me and guide me on all these things because there was very limited time after July. So many thanks for patience listening. And I hope I have been able to do justice.
Yes, definitely, sir.